way.
Robert and I have been friends for 20 years, thanks to this, mediocre mall retailer that's very undervalued at the moment.
Undervalued gem. Jeff, I think did we meet writing for the street.com in 2000?
It's entirely possible, man. I'm just still a little freaked out. The Stocktoberfest events like that are just like high school reunions for me, where I just have all kinds of people. I've played Where Did We Meet for the last week, and I'm terrible at that game. So yeah, we probably did. I met a lot of people. If you were at the street back in 2000, then I was there, or I was looming around, or we probably crossed paths.
Well, I wrote for him. Kramer got me to write, and we had a cocktail party in New York, and all the writers showed up. We may have met then. I don't remember.
There
either.
you go. Yeah,
I lost a lot of brain cells drinking in college, so my memory's not good.
That's okay. None of the kids drink anymore. It's very easy to see these alcohol numbers coming when you go to campuses and they're dry by choice.
It's very sad for Diageo.
Ben, do you have any thoughts about the quarterly refunding announcement coming out tomorrow? I mean, the financing estimates, I don't think were a big surprise, although the first quarter was higher.
I think the first quarter is the third highest ever.
Yeah, that was a surprise high. Yeah,
but it sounds like they're not going to do that much in duration, so they're going to keep protecting the long end, buddy.
Okay.
I mean, that's despite the long end selling every day. Although we must have gotten some data, it just went from up 4 bips to 1. What do we got here?
I mean, we're seeing no pullback in this 10-year yield. It just keeps rising. And if we get up to 470, which is where we were in April when we started this big decline,
Jolt just came in light.
Okay.
Little bond rally.
Holy shit.
Boeing 152, baby.
You making money?
143 deal. The deal price is 143.
Look at you.
Dude, I love it. The capital markets are back. I feel like the last 3 stocks I've talked about on here are, well, maybe not the last 3, but the KinderCare, which actually is going the wrong way. But, we had the Joby deal last week. We got the biggest deal since Alibaba, I feel like. Or maybe Rivian. I can't remember how much Rivian raised.
Thank goodness the bankers are finally going to catch a break.
Hey, look, we need more paper,
Are you shedding a tear for the bankers, Jeff?
Oh, no, absolutely not. I'm happy to see them getting deals done. I've got about 5 or 6 different companies I would love to see them get deals done on. Welcome the bankers. The lawyers I'm a little less excited to see.
Yeah, there's a lot of optimism around capital markets issuance, particularly M&A and IPOs. So a lot of the capital markets plays have been doing very well this year.
I'm just putting all my money in DJT, baby.
Oh man,
I'm kidding.
By the way, what a monster!
That is going to be that's a cautionary lesson in the making. That's actually what Christmas trees look like during the formation part. You can see it growing from a tiny sapling to a full-grown evergreen, and they're going to chop everyone's legs off in about 3 weeks. Just for a little holiday, just a little welcome to the new administration. I voted for myself yesterday, by the way. I wrote it in.
Yeah. I second that vote.
I'll embrace it.
Thank you. I felt best about it. I kind of reviewed the candidates, and I thought, who could run this place is probably me.
Yeah, and you could use your artwork to create some new wall hangings for the White House.
I think we could just use a rethink on a lot of our stuff, Charlie. Some of the art in the White House is probably on that list, but if a doodle helps America feel a little better, I'm there to draw and unite.
I went on Twitter and I asked Musk and Cuban to debate each other over their candidates' respective policies, but nobody got back to me.
Shocker. It's normally such a responsive, friendly place. Let's fire this candle.
Yeah, it looks like it's time to get started, so I'm going to get us started. Hello, welcome to Beats Roundtable. I'm Berna Barchet. Today's Tuesday, October 29th, just 2 more days to Halloween. Our group is here and ready to talk the markets and their best investment ideas. With us today, we've got Ben Bry with the deal of the day. Charlie Peabody's going to update us on auto sales. Jeff Mackey's got an update on one of his personal favorites, Peloton, and Robert Marson with one of his favorite energy stocks, also one of my favorite energy stocks. Ben, Boeing.
So Boeing basically is done a deal this morning, $21 billion deal, $5 billion in converts. That's at 6%, 20% above a strike above the deal price of 143. They did 112 million shares at the 143 price. It's trading pretty well this morning, 152.50. And it's funny because I'm now the aerospace guy, apparently. Last week it was Joby, and now it's Boeing. And just so you know, I don't really do aerospace, but I do like to go where other people don't go. And Boeing is a place that not a lot of people like to go. This has been a disaster for America, disaster stock. It's just been a disaster. But having said that, it's still an arm of the government. It's still a duopoly. They got this new CEO who is, a lifelong guy at Rockwell Collins, did a good job, ended up the CEO and sold it to United Technologies, was there for 2 years, and now he's got the unenviable task of turning around Boeing, which I don't think anyone's going to tell you is an easy task. But I participate in the deal, and I think it's an interesting place, at least for a trade, and you can start monitoring. And one of the things that's nice is when you do these recaps, it's often a nice spot to enter. And like Jeff talked about with Nike and Starbucks, new CEO, they got a lot of the risk of the near-term capitalization issues offset. So when you have companies just like Joby, although it's hilarious that I'm mentioning Joby and Boeing both as options, but you basically extend the maturity of the call option. And so now you have a longer runway for these guys to operate. And so I think that for a company that's one of the most important companies in America, that's really been, it's at the COVID lows, it seems like an interesting time to maybe get involved.
Mm-hmm. So do you think they did enough? Like this amount of money, is this enough to get them through this crisis time?
It will depend on, they want to do an asset divestiture of their space program, which has been kind of a disaster. And also what happens, the strike, they're still in the middle of a strike. I mean, there are a lot of things going on here. But like I said, often buying when things seem absolutely awful, if they can just go to terrible, you can re-rate to 170, 180 without too much legwork is kind of my view here. But yeah, they're not out of the woods at all. This is not a clean, easy thing to be getting involved with. But again, arm of the government. Government likes to spend money. This is a duopoly. I think it's going to continue to be a duopoly. I think the one wild card for the future of the cash flows is, the guys talked about creating a new 737 replacement because he's tired of seeing 737s fall out of the sky or not have a wheel or the plane door comes off or whatever.
Makes people squeamy.
And I don't know if they have enough cash for a full-on new program for that. So that would be a wild card. But again, I think of this initially as just a re-rate trade of you got some new shareholders. They'll probably give the guy a couple quarters to see how it goes. But yeah, again, this is not a home run, for sure. There's still risk here. The convert guys will be sellers in the market to delta hedge the $5 billion of equity. But I don't know. They have $30 billion of cash now. They're burning about $6 at the moment. But they've identified a bunch of contracts with the government that are fixed rates that they're losing money on. I think they fired the head of the few divisions. So it just seems like it's the beginning of a turnaround. Whether that turnaround works or not, you never know, right? But again, we're at the COVID low, and off a recap with new management, it seems like these are often times where you can you have a good entry point, if you will.
You feel like there's election risk? I mean, it's this with this strike going on for God knows how long. It's just one of the many irons they have in the fire. But you feel like there's any kind of hidden risk of if Harris wins, there's just going to be the perception that the union deal is just going to get dragged out even longer than it already has been.
I mean, yeah, and the other side.
I mean, you've got a great cushion, but yeah.
Yeah, I think that they'll eventually look. People can only strike for so long. People have bills to pay. The winter's coming. Although nat gas is a lot cheaper today than it was yesterday. But yeah, I don't see that lasting too long. I think maybe the risk that's more present is if Trump and Musk get in there and they're talking about cutting spending. And then, by the way, Musk competes with Boeing, with SpaceX. And a very well highlighted story in the media was that Boeing got a much bigger award than SpaceX did for a deal. And then they had 2 astronauts stranded up in the space station, and SpaceX had to go pick them up. So, there could be some risk from that. But again, I think that Boeing's just a strategically important company to America, to the government. And so, if they can get it together, I don't see them going away. It would be bad for America if Boeing went down the tubes. Let's put it that way. They also cut 10% of their workforce, so that should help with the burn going forward. The question will be, what's the loss to productivity and quality and those things. And that, I don't have an answer. I'm more, I'm a special sits guy, not an aerospace guy, just so all the listeners know. I just see how, we have recaps, we have new CEO, we have getting serious about cost cutting, we have auditing our contracts. So these are the kind of things you usually see when guys start to get their act together. Like this silliness that was going on forever, they're at least going to make an effort to try and get it the other way. And I go back to the idea that when you raise $21 billion in cash on a $90 billion market cap company, and 140 billion EV yesterday, now it's 120 billion EV. It should be, it should help the expiration date extend, and so there should be a little bit wider range of outcomes. And I think that's why the stock's up 7% off the deal price right now.
Makes sense.
Cool.
Makes sense. Impressive that they were able to do this size capital raise so quickly. Any takeaways from that?
Yeah, and I'd say this, just a little color commentary. I talked to a bunch of guys who are active capital markets participants, and allocations were very light, which is usually what you want to see. You want to see smaller accounts, non-strategic accounts getting 5,000 shares, no shares, 10,000 shares. Like they want to place this with guys who are online with the story that want to come in here and be part of this. And I've talked to some more macro managers as well who have been anticipating this. They're like, hey, whenever they do this deal, I want to get involved. So I think there's a decent amount of shareholders that have been looking for this deal to happen. And, if you think about energy recaps in 2016, that kind of marked the low for energy. Other than, COVID was the low, but that was an unexpected event. But the 14-15 downturn in energy, and all those guys went under or they got really bad balance sheets. Well, there was just 2 quarters where everybody got recapped, and they pretty much all traded up for at least a year post those recaps.
Sure. Okay, so I'm going to move on. We've got a bit of a transportation theme today. We've got planes, autos, and bikes to nowhere. So let's, we're going to go from increasing level of distance and go from planes to cars. So Charlie, auto sales, you want to catch us up?
Yeah, so I'm going to continue with the theme that things that need to be financed, cars, boats, homes, RVs, are going to continue to disappoint, largely because of affordability issues. And the financing rates aren't getting any cheaper. But this Friday, specifically, we get the new car sales data. Estimates are 15.8 million seasonally adjusted annual rate. This would represent an 8% increase year over year, a 10% increase month over month, which sounds healthy, but we've got, 4 more days in this selling season than last month, and 2 more days this October than last October. So that's helping the overall increase. So I think we've seen companies like AutoNation disappoint with their guidance last Friday, and I think we're going to continue to see auto sellers like CarMax, Carvana disappoint as well. The other thing I would also mention is that we now have about 24% of all cars that are being financed underwater. That means the owner of the car owes more than the loan than the car is worth. So they owe more on their loan than the car is worth. And we are starting to see a pickup, a real significant pickup in what we call frequency, which means delinquencies, and severity, which means losses on these loans. So I think lenders like Ally Financial, Credit Acceptance, Capital One are all going to start experiencing higher loan losses. I would say that the big banks are generally better underwriters than the monolines. So I'm not expecting it to be a significant problem for the big banks. But a company like Truist, through their subsidiary called Regional Acceptance, does do a lot of subprime lending. So losses in the subprime area could rise to 5-7% of loans. So it's, along with all the other, things that need to be financed, autos are going to continue to be problematic. And I think we'll see that in the data on Friday, although I don't think anyone's expecting good numbers anyway. So it shouldn't be a big surprise. I'll stop.
How many quarters away do you think we are from seeing those write-offs go up?
I think you'll see in the first half of next year. One of the things that is happening right now is you're getting some forbearance in places that have been hit hard by the hurricanes. And so some of the companies have said in the fourth quarter, we won't see as big a pickup in losses, but in the second quarter of next year, you will start to see that flow through if the forbearance doesn't help people get back on their feet.
Got it. Okay, something to keep an eye on then.
Yeah.
Thanks, Charlie. Jeff, some
Yes.
thoughts on Peloton, and I just gotta give you props for being, one of the true beasts of the platform. I don't know if that influences how you feel about the stock, but if there was a vote for president of Peloton, you have my vote.
My being the greatest senior rider in the history of Peloton, many consider me the Lance Armstrong. That doesn't bias me at all. Neither does Peloton becoming an Olympic sport. There's a lot of chatter surrounding that, but I like it as an investment here. I got a whole write-up and go to Wall Street Pizza. You can read about it there. But the bottom line is this company is just not as screwed as people think. And you've got an 18% short interest ratio. You don't really have a CEO. You've got a coherent plan, though, for the first time in ages. The people that are running it now have kind of set them on the right track. They've got $200 million more in expenses they can save. And people still hate this stock. This stock really, with how far down it is, it's down 95-odd%, like a lot of the fallen angels that you saw from the COVID worlds. But really, in a lot of ways, this is just a much better company now. And just like those other corporate stalwarts, Boeing and Joby, Peloton has recently extended their runway. They've redone some of their debt, so they have a little more time. And between kind of the subscription rates that they get, the margins that they get away from hardware, they've just got a real opportunity to basically they can triple from here or they can go to zero. It's not completely out of the realm of possibility they go to zero, but I like the risk reward and they don't have to be that much better. They're going to be cash flow positive next year. So the multiples start to work pretty fast with pretty high margins on their core business. People aren't quitting. Check out the longer form story of it. I don't want to waste too much time on this kind of, there's people have feelings on Peloton. So the haters are already going to hate it and are already giving me crap right now. So I'm not going to fight you on it. You want to read the case on it, though? Check out Wall Street Beats.
I'm kicking myself because I did, I was asked countless times, like when this was in the teens, like, is it time yet? And I kept on saying, it'll be time when it's under $5. And I completely forgot to set up an alert and I missed it. Now it's $6. Maybe I'm just splitting hairs, but, to me, the really easy trade was from 3 to 6. Like now I feel like they actually have to, put up some results with the numbers going the right way. I mean, we know it's not going away. They've got the extension. We all know that, they've got whatever it is, $3 billion worth of recurring sales. Those people aren't quitting. I'm one of them who barely uses their bike anymore and is back in the studio, but I bought this expensive piece of equipment, so I'm not turning off the software. And so they've got my subscription. And then there are people like you who are on there every day who are never going to quit. So, but if they can just get the hardware to break even, but what
a sticky user base is the thing.
What about the operating expenses? Because you had Barry McCarthy, super respected and seasoned executive, who was there for, I forgot, like a year, 2 years, who was recently departed. And, he was very focused on getting these expenses down. And I don't understand why their expenses are as high as they are.
He was focused on three things, and it kind of started with marketing. That's where he made his bones, was Netflix, and he thought that he could just really drive subscriptions. And the truth is, coming out of COVID, you pulled forward a generation or so of demand for your spinny bikes. So I'm on the bike, like an hour a day. Not even I think it's a growth industry. It's like, have fun with it, but I mean, come on, it's everyone's not going back to a shutdown world of Peloton again. But the people who are there aren't quitting, and they aren't quitting out of vanity or just it's kind of an admission of failure, just like it is cutting your gym memberships. Barry didn't cut expenses, and he still couldn't get the bike production down. And so to still have production delays this long into it, to still be spending tens of millions of dollars on R&D when you're selling a bike that has not just an iPad on it, but now you've got an iPad that's like 5 years old. So there's got to be more cost savings there. I mean, they're just buried in there. And I think Barry kind of bet it all on trying to keep this to be a growth company. And really, it's not. It's let's maintain these users. Let's just kind of think smart about it. They're advertising to men for the first time. It's not that I love the Disney dancing classes so much. It's that you go on there and race, and that competitive aspect of Peloton where you're just, let's go grind and do cardio. That's kind of what the enthusiasts like about it. It's not different than a lot of different hardcore type of exercise things. And, to have the watts, they're going after men for the first time. Right now, 62% of the user base is female. It's a huge opportunity, and it's just smarter marketing than we saw before after years and years of just lamentable ads from Peloton. And they're not spending just a fire hose of money at it. And so they're controlling the expenses, and there's more to come. They think they have 200 million more there for a company that doesn't need much more than 400 million cash flow per year on a mature basis to be really cheap. That's kind of a lot of savings, and I think they're sandbagging it. I think current management is smart enough to actually be conservative on that number.
That makes sense. So if McCarthy made a mistake, it was that still chasing the growth dream, because this is a company that can produce a lot of cash if run for cash. It needs to be milked for cash. And he just couldn't accept that, having come from Netflix. And,
he just kind of thought there was going to be a way we can turn the spigot on. Yeah, we'll run a few sexy ads and we turn the spigot on and people are going to be buying these again. And that just wasn't realistic. They still have stores. Honest to God, I don't know why you would have a store. They're the most depressing places on earth. And again, a little bit of an enthusiast, so I'm a little bit biased, but I'm more biased against bad retail. And they're renting mall space at fairly expensive rates that they're going to have to try to wind those down because it's just not an impulse item anymore. It's going to be, what mature exercise business is, which is not very sexy. It grows at roughly GDP, and you need kind of a nice little economic tailwind, but you get anything going right, and it's a cash flow business. This is going to make one hell of a private equity deal. At some point, at some level, somebody's going to just, buy it and say, what's nice about not being public is we don't give a shit about growth anymore. Beautiful. Let's manage it for cash, and let's just make classes that people want to take, keep it sticky. And, they're not clothes hangers yet. Like, people are still using them much more than they use their gym passes, much more than people would expect. And as long as that's the case, Peloton is going to be alive, which is terrific and good enough for me.
And Jeff,
when you declare victory, I suggest you do it from your bike. So you should stream next time when you do an update from your bike.
I'm not sure the world needs to hear me declare victory for my bike anymore. It seems, I don't think it's a respected art form, the Peloton ride exertion until you throw up. But I'll keep that in mind. When I do declare victory, maybe I will. I'll be sitting on the bike. I'm probably going to be sitting there anyway.
Jeff, one of the things, I was short this thing, and the idea, well, first of all, the idea that it was Nordic Track number 2, and that worked out okay. But
completely.
The idea is that they pulled forward a lot of demand, right? So you're like, hey, this pandemic happens and we pull forward 5, 7, 3 years of demand. Is there like a chance where like, okay, everyone bought one, then there was people who didn't want them, they flood the market with supply, and now we're kind of normalizing as we go to 2025, 5 years after the pandemic, and we could have like more of a normal, you know, replacement
I think
cycle
you make it
plus maybe a little bit of organic growth? Is that like kind of?
you know, it makes me more bullish because they're so bad at making hardware that I don't necessarily want demand to be spiking all that much, because I'm not so red hot convinced that they fixed that problem, despite the fact that they paid $420 million for Precor, which is weird that they can't make a treadmill, but they own the biggest treadmill maker. They're, again, it speaks to the opportunity. But on the hardware side, they've kind of let that go a little bit. They're doing a deal with Costco now where you can install it yourself. Peloton used to be real hands-on, real just, we're going to install this for you, we're going to do all that business. It's a better business to focus on subs. They make 60% gross margins on subs, 60% plus, and they break even on the equipment. So if they can just handle the equipment, if they can just handle, even tepid demand, they don't really need to turn that on so much as they to your point, they need to kind of normalize it. They can't just have an eroding base forever. But churn is pretty well under control. And so if they just do more compelling marketing than literally like scandalous marketing, they use that Mr. Big Guy, he died on the bike in an episode like 3 weeks later. Before that, they had the wife that seemed abused in many corners. I mean, it's not a proud history of promoting the brand. So, it's I think they can kind of stabilize that. And if they can keep the churn level, the product mix, if they drive subs, just on a moderate basis, those margins are so much better than hardware. That hardware they don't really need that side to grow. They just need to keep the subs they've had, and that works well enough for them. If they can add subs, that's just gravy, And again, it's like any other business where it's kind of priced with a big chance of dying. The further you get away from that, it's like, holy crap, we figured out hardware a little bit. Well, that's an extra 50 million.
I don't understand why the margins are only 60% in the sub business. I mean, unless they're paying each of those. I mean, I can understand if there are a couple of those personalities that they're paying like $1 million, like Cody and, a couple of the other superstars. But like, there are a lot. I mean, a lot of those people are, are probably not making anywhere near that. I don't understand why the product cost is.
I'm almost 4,000 rides into it, Bert. At this point, I'm taking the German Halloween ride, which I literally didn't take. It's great to ride with the Germans because everything sounds like "Go faster, you lazy bastard," which is motivational. But I mean, the bench is pretty thin. They're not paying those guys a ton of money, and they're cutting a lot of that out. And so part of those expenses are the music fees. Part of them are just kind of keeping the network up and robust. That was getting a little creaky under Barry as well. So, there is some cost there, but it scales really well. The incremental user doesn't really cost anything for them. And so that margin just gets better.
And I will point out, one bullish point, I mean, and I guess that's in the margins, but, as somebody who's tried a bunch of the competitive services, their music, licensing is truly a competitive advantage because nobody else can invest in it in the same way. And it's such an important part of the platform. So
their content is just better. That doesn't make it a growth business. That doesn't make it all that in a bag of chips. I'm kind of being snarky about that, but it's a better service for what they do. You just got to figure out what working out at home is.
It speaks to the lower churn. Well, it sounds like we're keeping your dog awake, Jeff. I hear
she hears me talk about Peloton all the time. I'm sorry.
So I want to move to Robert, who's going to update us on one of his energy favorites, also one of my energy favorites. What do you have for us today, Robert?
Oh, I have competition for most hated sector of the stock market versus Peloton with Jeff, because the oil service stocks are reviled in the stock market right now. The growth investors don't like them because the growth is slow and the momentum they got no momentum, so they're negative momentum stocks. They're cheap, but the value guys say, it's a value trap, don't buy it. So it's a sector that has declined with oil. By a multiple of the oil price decline. It's now compellingly cheap relative to historical valuation levels. As people know, valuation's my thing. It's what I do. So if stocks are down and they get too cheap to be true, I start to get involved. And this stock is going from $135 down into the low 80s, where I made it a starter position. I bought more in the 70s, so I'm in the stock around $80 today, and it's just it's too cheap not to own. It's not a trade. It's an investment, because the stock's not going to work until oil stabilizes and go back up. It's that simple. So oil's come from 90 down to 67. If the next 20 points in oil is down, I'd say we have some severe economic problems. If oil goes to 47, all the industrial stocks in America are screwed, not just the oil service stocks. If oil goes back from 67 to 87, then this stock will go up 50 to 100%, because at 4.5 times EBITDA, when the stock market is 16 times EBITDA, for a company that uses technology to improve efficiency in the production of a good, energy, if this were in any other sector but oil service, it would be triple the EBITDA multiple it is today.
Right, as a technology leader that can improve efficiency. So what do you think, do you have an opinion on the next move in oil? Do you think that we're reaching some kind of basing level? It's kind of almost counterintuitive that you have like the Middle East on fire, and it's been terrible for oil prices. So if not now, then when are we going to get better oil prices?
My opinion on oil. The oil industry is, a few million barrels, over capacitized. So the oil business runs at 97 globally, 98%. It's not like a wash in oil. It's not like deep cyclical businesses that drop down to 50 or 60 or 70% operating rates. And, we're one event somewhere that takes a couple million barrels offline, geopolitical, mechanical, that tightens the market back up. So I don't know. I got hired at my second job in the oil business in 1988 to be an oil analyst at Miller Anderson. And by 1990, I had figured I can't forecast oil. So I don't forecast oil. I can tell you that you don't buy oil stocks after oil's going up a lot. And you do buy them after oil's going down a lot. Now, oil's going down some here. It's not, I don't know whether a lot is 67 from 90 or 57, right? But I know the next $30 move in oil ain't south, most likely. And if it is, there's going to be an economic crash, a global economic crash, in my opinion. So that's your negative outcome, in that the global economy collapses. It's not EVs taking over. The EV installed base is a pimple on the butt of the installed base of oil, gasoline, and diesel consuming cars. The fleet is billions, and it's when people see, China electric vehicle growth is crushing oil demand, therefore oil should go south. That's just stupid and silly. So I just think we're closer to the bottom than we were at 90, and oil's had a big decline. So people should be getting their feet wet with these stocks and not going all in. But that's exactly what I did in my portfolio.
I would add that with China is that they're also selling cars to the emerging markets now and getting guys off the wagon or the bike to a $10,000 car, because they have such a cost advantage versus the world, which is why you hear European and American politicians be like, 100%, 200% tariff, because my favorite Chinese stock, BYD, but they're just resemblant of the whole sector. Oh, those guys can produce cars, so they can grow oil demand by just getting guys off the bikes in the various emerging markets, and I don't think that's talked about enough.
The internal combustion engine fleet of vehicles grows every year a lot more than the fleet, obviously, for electric vehicles. So there's demand for gasoline and diesel for 30 years at least.
And hybrids outpacing both EVs and ICE. So I think the hybrid is something that people are adopting to a lot. They're very nice, and so it's kind of a middle ground vehicle, I guess you'd say, and that
kind of just sitting there being the obvious answer for how this should be the primary mode of conveyance. Because boy, it doesn't make hybrid make a lot more sense than just forcing someone to go one way or the other. But
Correct.
That's a whole nother screed.
Yeah.
Robert, I want to ask you one other, one other thing about Weatherford, sort of going into the weeds, but there's been two things weighing on the stock this year, I think. One, obviously, oil prices and, what that does to future perceptions of revenue and cash flow. But the other thing has been, capital allocation. I mean, this is a high class problem. Like, if anyone doesn't remember, this company went bankrupt in 2019. And, like many energy companies went bankrupt in the teens. So not necessarily unique in that that respect, but good assets, bad balance sheet, came out, better balance sheet, and the balance sheet's just gotten better. I mean, now they're in this high class problem. They're maybe like half a turn levered, and it's just amazing. 5 years after going bankrupt, they're potentially overcapitalized. They announce a buyback. They put in a dividend. And I've heard people complain that the dividend wasn't enough or that the buyback wasn't large enough. Does this need to be a net? They still are paying down the debt, even though they're less than one turn levered. What do you think is appropriate leverage here? And, do they need to be buying back more stock, or would you prefer to see the dividend higher? Like, what is the right capital allocation policy here?
Well, I'm new to the story, Berna, right? Because it fit my buy screen, and I haven't owned it for 2 years. I bet against it with another guy, and I won the bet, so that's why I'm revisiting, because I really like his analysis. And I'll give you my impression. Listening to the calls about capital allocation on that last conference call, I get the impression that management is not completely sold on the the buyback. I think it wants to be more opportunistic. They sound like they want to buy back the annual dilution from options exercising no matter what. It was a modest start, in my opinion. Both the buyback and the dividend were modest in the scale of things, but they had a phenomenal quarter cash flow wise. They paid down $200 million in net debt. They only have $600 million in net debt against the $6 billion company. They do $600 million in free cash flow every year after capex and taxes and everything and interest expense. So it's a company that is definitely well positioned. My guess, being new to the stock, is that because they've focused on their higher technology services and products, my guess is they want to use the leverage capability to add another revenue business that adds even more technology and IP to the company. Because just reading between the lines, it does, it sounds like they're doing a dividend and a buyback, but they're not trying to take advantage of a very cheap stock and go all in on the buyback.
Yeah, I mean, I agree that Weatherford has been an acquisitive company, and the leverage around that was part of what helped them get into trouble,
Right.
plus years ago. But yeah, I mean, that would be probably the only sort of silver lining to lower oil prices. You could see some other companies, maybe with a good piece of technology here and there, get themselves into trouble.
Yeah.
So.
I mean, if they bought a $500 million revenue business, that would add 10%, 8% to the sales of the company and to their normalized earnings power. One of the points I'd like to make here is a lot of people don't mind leverage business. I tend not to own them. And the reason is it's not just the safety of sleeping at night without the leverage. It's that leverage borrowing power can be used if a company goes to normal leverage ratios to add permanent normalized cash flow and EBITDA, because they could buy companies. So this company has an ability to grow through a down cycle inorganically if they did a modest deal and it was nicely accretive. And at the bottom of the cycle is when you want to buy these businesses. So my guess is they're prepping the balance sheet, to try to do something on the acquisition side.
Mm-hmm. I agree with you, and I like this management team. So one definitely to keep an eye on.
They're excellent. They're excellent fixer uppers, and if they could find a fixer upper property, and add a chunk of revenue, that would be a very solid thing for shareholders.
Agree. Well, I think that, I guess, that sort of brings us up to date today. If you liked anything that you heard, you can find more details on Peloton, Weatherford, Boeing, wallstreetbeats.com. And you also find our real-time chat there, call transcripts, and more. So thanks for being with us today. I'm Berna Barchet, and we'll be back tomorrow with Wall Street Beats.
Peace.